So my name's Dave Boyle and I run the Community Shares company, which is like a boutique advisory service for organizations who want to use a specific form of equity crowdfunding called Community Shares. And I'll say a bit more about what Community Shares are and where I think they might be useful for the context in which your cohort of learners are going to be thinking about raising finance, and where they might speak to those needs, and where there are some issues which people need to think about very carefully before going down this pathway. Community shares are essentially a way of raising capital from a community of supporters, no different to equity in that sense. Traditional equity, you've got to like what you're investing in. Community shares are different though, in that they are specifically a form of capital used in societies, which in practical terms, a society and a company might look and operate very similarly. You might not know you're dealing with a society as opposed to a company, but under the hood, at the back end, so to speak, it operates using a different legal framework, which in many cases has got similarities, but it's got some really crucial differences. And it grows out of the United Kingdom's cooperative movement traditions from the 1840s onwards. One of the reasons why it's been undergoing a bit of a renaissance is that the 2001 Financial Services and Markets Act in the UK, which regulates financial services, including selling investments or making investments known to the general public. There's a whole heap of regulatory hassle, for want of a better word, which comes with anybody who wants to try and raise capital from the general public. There's a whole load of assurance which needs to be gone through, essentially to ensure people like your nan and granddad don't get their pensions filched out of them by a snake oil salesperson who basically is telling you about this wonderful investment opportunity which is going to make them a fortune. It all has to be couched in very dry terms. It has to be signed off by a regulated financial professional, usually an accountant or broker or some such person. And that doesn't come cheap. Getting a quote for that kind of work is a job in itself. But you're looking at sort of £15,000 and upwards before you've even raised a penny. These people don't get out of bed before you've worked out how are you going to pay them to perform this kind of service. So societies, though, are exempt from this regulation, and that means it's a relatively easy and cheap, and that's the critical term. It's accessible to people who don't maybe have quite a lot of cash at the moment, or for whom cash flow is quite a challenge, which is often businesses at this stage of their development cycles. And it means you can, if you've identified a crowd of potential supporters who are you think we're going to be interested in what you're actually creating, you can go to those people for capital. So some of you might be familiar with Nathan Schneider's work on exit to community. And it's basically an operationalization of that process. You have now, in Nathan's sort of imagining, I think businesses maybe are a little bit more mature. They've already built a community around them. And then the founders say, so you guys want to step up and take some of this equity on. In community shares, it's often much more used at the starting point, where your community's in formation. And that's one of the challenges which I'll come back to. Why is it good? You actually get to share ownership with a bunch of people who are interested in living in a world where you have successfully built your business. They want you to succeed. It's not the kind of if you build it, they will come. It's if we come, we can build it. And it kind of inverts the normal process for a bunch of people who go, yeah, I really like the sound of what you're trying to do, and I like it so much, I'm prepared to put my own money in order to help it come to pass. It's a democratization of equity finance. It's much more investments are at the £500 average level as opposed to £50,000 or £5,000. You can get tax reliefs for it, which you can get for most of the other types of equity you would crowdfund for, such as EIS or SCIS. And so it's really useful in that sense. Where's it more challenging? Well, the big issues really are, there are two specific issues which I think flow from it being this particularly weird type of investment. And the first one is that as a society, it's regulated by the Financial Conduct Authority. And that's a critical thing because the FCA is much more of a hands-on regulator and registrar of societies, much more than Companies House is. Companies House couldn't really care as long as they don't really even check that you're any changes you might make to your articles of association are legally compliant, they process and file them and put them up on their website. The FCA, which does the same function for societies, though is much more hands-on, and it will check that everything's present and correct, and that you're legally allowed to make the amendments you make to your governing constitutions. And crucially, it goes with the territory of a society that it's a democratically run organization. So one of the big differences, which is much harder, and one of the reasons why I think it's much more challenging in this particular sort of startup space, is that you've got to get rid of the business. The idea that you could sell maybe 10% of the business and raise X amount of money and keep a certain amount of shareholding yourself just doesn't exist in community shares. It's not possible. It's not possible to have more than one voting share. So regardless of how much money you put into a society, you end up with one vote, like it is in a country. No matter how much tax one pays, you get one vote in an election to determine the government of the day. It's the same in a society. In a company, obviously, you can have different weights, and you can have some people, i.e. founders, can have, I don't know, 65% of the votes, or you can have an investor who has much more influence and greater participation. It's much more difficult to manage that in a society structure. There are two different types of society. There's a community benefit society, which is the predominant legal form which is used for people trying to raise this kind of capital, or there's the cooperative society, which is increasingly being used as well in platform co-ops specifically, and they have their differences, and if people were genuinely interested in wanting to understand the difference between these two and what might be more appropriate for them, then my details will be at the end, and I'll be happy to talk to anybody about it. But the key thing is, in either of these two things, you lose power. Now, you maybe get to the stage where you think, what's the point of being king of my business, queen of my business, and my business is not going very well? I have complete control over something which isn't happening. Or you could go, I'm happier, I want this thing to work, and I'm happy to share control and influence with those people who help me make it work by investing in what we're about to do. So, you pay your money, you take your choice. And many people I speak to are really up for the idea of cheaply raising capital from a bunch of supporters. They're less interested in the sharing of power, and that's completely understandable. I make no moral judgment about that. So that's one big issue to factor in. The second is that the maximum amount of investment an individual or a company can make in a community share offer in the capital of a society is £100,000. The vast majority of share issues don't trouble the scorers on that front. You might get somebody who puts in 15,000, 20,000 maybe, but £100,000 rarely has a society got to the point of going, oh, would that we could. But if you're particularly in touch with people for whom £100,000 and above is the kind of investment they're thinking they'd like to make, or you need them to make, then it's a bit more tricky to manage that in a society. You can hack this particular, this rule, you can get around it, but it's convoluted, and I'm not going to bore everybody with the technical details, even though I'd love to talk about them, because it's what gets me out of bed in the morning to talk about these very technical details. The final thing which is problematic about the sort of community shares thing, it's not problematic, it's a challenge which comes with it. And it comes back to this point I alluded to at the start, which is the exit to community requires a community to exist. It's all very well saying we've got a fantastic business idea which will be revolutionary, transformational, socially impactful, yada, yada, yada. If actually at the moment the only people who know about it are you and your family and friends who you've been boring about it for the last number of years as you've become monomaniacal about it. So you need a community to exist in order to become your investors. You can try and convince some people using social media, hey, you've never heard of us before, but we've got this great idea, or we need you to invest in it. Might get a few people, but unlikely to. The work of building the community of investors is the hardest part of any community share issue, and the most important. Many of the people who've used community shares have been doing so again against a backdrop of having been continually building that external community for years. And if they've not been doing it for years, they've got some networks in. So let me give you a great example. One was called Signalize, which is a co-op I worked with, which is a platform to enable deaf interpreters, people who do sign language interpretation for people who are deaf and hard of hearing in contexts like GP surgeries or law courts. And increasingly, these people who are being trained up, it's a several-year process to be trained up to do this work, and you end up basically, working for coins as private equity is driving out all of the good practitioners, because they're just sort of squeezing and squeezing the unit of labor at the end. So they're basically a co-op of people who are interested in getting paid a fair day's pay for a fair day's work, and they're looking to create the booking engine which will enable people who need interpreters to link up with interpreters. Now, they were a new business, but because they were active within the community of deaf interpreters, they were known. They also provided, in their personal capacities, they provided work for all sorts of different organizations who had footprints which were greater than just that organization. So some of them used to provide sign facilities at political conferences and so on, the people who stand at the side and interpret. So that gave them access to people who had quite large footprints in social media, and they were able to utilize that. But they built a crowd out of people who didn't realize that they were their crowd. The other thing they did was use a platform. There are two platforms you would use to do community share offers in the UK. One is crowdfunder.co.uk and the other is ethics.org.uk. That's ETHEX.org.uk. And Ethics was the one they particularly used because Ethics have a database of around 15,000 philanthropically minded investors who've invested in things like community energy or wind turbines or solar PV in the past. And these are people who've got reasonable resources at their disposal. They've done well in life, and they want to make sure that their money does good as well as makes some money back to the classic social enterprise kind of patient capital provider. So Signalize were able to blend those two communities together. Half of the community who were kind of, we'd love to live in a world where you were succeeding. And the other half was we'd never heard of you before, but it looks good and it looks like it will make a difference in social terms, and we're up for funding that kind of thing. So that was a good example of how you build a community. Others have, but it's the bit which businesses who are looking for startup finance struggle with the most, because they're often not able, the reason why they need to raise capital is to broaden their reach and scale, and it's only having broadened their reach and scale that they'll be in a position to actually say, hey, we've built a community now. So there is a kind of cart before the horse dimension, and that's where platforms like Ethics can come in handy, because we that there are people who've got a proclivity to back this kind of thing. Where can you I know that some of the people on the cohort are going to be based in the UK, which is, you can definitely use this. I've worked with another group recently who are based outside the UK, but they are registered in the UK. So they've created a society. They all live in different parts of the world and they trade all around the world, but their base of operations is in the UK, and they've registered a society and they're undertaking a share issue, even though they're not actually, they're trading globally. And so they trade in the UK and lots of other places too, and they've managed to do it. So as long as you've got a legally registered society in the UK, you can use this, because the FCA, when it registers societies, doesn't undertake to actually get to the bottom of where is your trading footprint. In fact, it doesn't care. As long as you are registered with an office in the UK, which is not a PO box, the individuals who register the business don't have to be resident in the UK, and the business doesn't have to trade in the UK, though obviously as a UK registered organisation, you would be subject to taxation by UK tax authorities on your corporate profits. In terms of, so let's say you've been listening to this and you're thinking, this is interesting, I'd like to know more. I tend to work on the basis of, I'll give 30 minutes to anybody for a chat about what they're looking to do. And I'll give you my honest feedback as to whether I think you've got the basis for a share offer, and not just the basis for a share offer, but the basis for a share offer in practical terms. Anybody can run a share offer, but you want it to be successful. So I'll give you sort of an estimation of where I think the challenges will be, and we can have a conversation.